Hey everybody, it's Pete Carmesino here at the Halftime Show. I'm the Chief Market Strategist at Chaikin Analytics. And, weekly we kind of put this show together and kind of look at what's going on here in the markets. Last week we took a little bit of a break. The week before, I was on the final bar with Dave Keller. That was awesome. We had a great time. So if you didn't see it, tune back and throw some comments up about that. We were just talking about a lot of things that were kind of on the cusp of changing. A lot of opportunity here in the markets. We're looking at, a lot of things happening. And some of the things that I've been touching on have been fixed income, interest rates, and the dollar, right? So we've seen the TLT rally right off the top of that range I've been calling out now for, 18 to 20 months or so, if not more now. And the reason is that the rate cut feeling of the potential of that, the pause from the Fed now, the no action since July, is really giving the markets the ability to, well, at least they think so, to read the future. We know that as well. We're looking at it, and I've been calling it out now for several months, if not at least for the second half of this year. And the fact is that when unemployment starts to rise, you're going to see the Fed act, right? It's never not done that. That's just the statistics from the past. I'm not making that up. Go back and look. I've showed you the chart 100 times. And just yesterday, one of the Federal Reserve governors, Waller, had pointed out that, I'm just going to look at the note here from the news clip. Christopher Waller, member of the Fed, he just said he raised, quote unquote, raised the possibility of a Fed cut as early as spring. Now, we've been talking about that. The cuts have been pulled up from July, June to April, May now. And obviously that could even happen sooner. And even folks like Bill Ackman, who kind of was on the same path that I was, looking at interest rates and bond prices, has obviously reversed course. He's also looking for a cut. Now, we're all looking for it because it's kind of in the cards, right? And then when bad news becomes good news, right? When the unemployment rate starts to rise, it's up 14% this year. I know it's coming from a low level. It's around 3.9. We're going to learn more about that very soon. And what I'm saying to you is that when that starts to rise, no one knows the point at when the Fed will cut. I don't know if it's 4.6, 4.8, 4.2. All I know is that when that rate starts to rise, the Federal Reserve will probably take some action. And the action could be no action. In other words, it could stay paused now for months. Again, that's still an action. Don't forget, they've got quantitative tightening still going on, in the background. A lot of people forget that that's happening. And so, they could pull that in, right? They can adjust something. They can slow it down. They can change the pace, right? So the Fed has some tools there that, aren't front and center on everyday news, but let's pay attention to that. So I'm going to look at TLT. I'm going to look at, the S&P 500 that filled the gap on the upside. Now, that's kind of old news already. It's happened and kind of stay there, but it's going to be a level. It will act as support potentially, and it may be acting as a pivot, believe it or not, to higher levels. I know I just said that. I know maybe I'm a little late in calling that, but the fact is that we've been tracking this and looking at the channel. So I built a channel just forward looking and saying, by the end of the year, what if the S&P can live on that trajectory, what level can it get to? It looks like it could maybe go over 5. Again, that's wishful thinking. Nobody knows the future. I'm not making that, again, a prediction. I'm just looking at the chart and saying, well, this could be natural stops. These are like stops on a train path, right? Each level has a meaning to it. The previous levels were obviously gaps that were filled, that were used as pivot points. They moved higher. Sometimes it's a moving average. Sometimes it's just news. And sometimes you're just getting a rally for the sake of getting a rally here, because there's a lot of people that were kind of left flat-footed or offsides or whatever, term you want to use to kind of describe folks that are in the FOMO phase right now and rolling and rushing into these stocks. So let's hope that's not us. A couple of things I want to look at. There's a couple of relative strength changes on the downside. If you've got stocks that are on the downside in this kind of market, that's a problem. So you better be aware of that and take a look at what's going on there. Sorry, my phone was ringing. And there's only 2 I'm going to talk about today. And I'm going to look at the top sectors and then the top subsectors. We're going to make this a quick one. But let's dive into these charts and see what's going on right now. All right, I'm diving into the TLT to start. That's the one I mentioned first, so we'll look at it first. Now, it didn't get to my levels here on the 10-year, right? I was looking at a 520. That was kind of being a little bit too cute. The 5% level was sort of a natural psychological area for things to turn. And what did happen, though, is it did get to the top of my range, didn't quite get into the target box. But let me tell you something. That's pretty darn close, and I'm going to take it because right around October 10th or so, I talked about lightening up the short position if you were, and holding some for the ride. Now, on this reversal, this is a reversal. When you're looking at these massive and quick moves higher, you got to take it off the table. So, I mean, that's just good trading. That's good risk management on the short side. Now, if you were short from way up here, congratulations. A lot of people were not, obviously, and a lot of people were trying to bottom fish all the way down, and they're probably not even at break even yet. So there's a lot of a push and pull in between here. I'll call this purgatory or no man's land, because in this range between, I would say, 90 and maybe 105, 106, there's probably people that are, almost going to start breaking even here, which will lead to what? Probably selling around that level between 100 and 105. Again, I don't know that. It's just something that I've seen over the years, and I'm just kind of looking at, sort of reading the tea leaves. But that's what I see with TLT here. I like it. Obviously, it's turned. We want to see lower rates. That's great for the market and all that, good stuff that we always talk about. But be careful what you wish for. When the Fed is cutting rates, it's not for a good thing. It's for a bad thing, because unemployment could start to rise more rapid than they anticipate. Just like they missed inflation on the way up, they could miss the unemployment rate moving higher than they thought. Okay, so this goes against my better judgment, right? We're talking about not making predictions and that kind of thing, but I'm just drawing these two areas, right? This was the previous high, 48 and a quarter or so. It's not exact. Don't at me if I'm like wrong or something about the exact number there. But that's kind of where it was. If I scroll back, you can see where it was right around here. And then, if I look at the end of the year, right, if we get to around that, January 1st of 2024, December 31st in that time frame, and I just drew this sort of, obviously vertical line against the channel, the point could see somewhere around 5,000. So if we get into this gap, that would be pretty amazing. Let's be honest. And I think if you're looking at sort of what's happening right now, there's really not a lot slowing it down. Now, if we get some other bad news or something else happens, it's certainly possible. But this was the gap I was talking about. You see this gap here back from between July and August. It gapped down, and now that gap has been filled, and it kind of, look how it stood here for a little bit. The same thing happened here. When this gapped down, it came back, filled it, and then went lower. And then look what it did. It kind of slowed down around here and started to move higher, right? So the thing that happened here is there's more gaps were created, right? So this one's effectively filled, right? So what I might do here is I might change the color here just so we're aware of it. All right, it's red. That means it's filled. And so is this one, right? And so when I look at these two areas, I should say, they could become areas of push-off points, like a pivot point higher, right? So we might just meander here. We're not really, rip-roaring today, up about a third of a percent. That's still pretty good, but, I don't like to see that big push higher just right around these previous highs. If it can't get above here, it's just all too close to call and say that we're through and ready to roll. The point is that if this resistance is real, it should roll over back to the channel and potentially back to this area again. And if these don't hold, these two gaps here could come into play. Okay, I'm getting a little fancy here on this NDX chart, the Nasdaq 100. And what I mean by that is you see these dashed lines. I'm kind of drawing what some folks might refer to as sort of a fractal way to look at trends. And so there's the channel in the green on the way up. It broke that. It held the 200. It never really filled this gap here, which I was calling about 14% pullback really from the top here. And yet at this level of resistance, and I should say this trend line, look where we ended up. It's pretty amazing, folks. Now, I drew this, I don't know how long ago. My point is that it's just amazing to me that you see these levels come into play. So this is critical. I think we're both, both indexes are at their previous peaks or recent peaks, not their highs, but at their previous peaks. And I think this is a moment of truth. And so we need to see some movement higher. And obviously, that's what we're getting. We're not getting in a lot of bad news. You got Fed people talking about cutting rates. That plays on the minds not only of the bond market, but of the stock market. When you hear lower rates, you think higher prices in stocks. But at the same time, please remember that when rates do get cut, that's not necessarily for a good reason, right? That means the economy is slowing down and it could affect stocks to begin with. So in the beginning of that phase, what you might see is stocks react negatively. Even though we're pushing higher right now, that's kind of seasonal and year end. I'm just calling it out that we're kind of at these inflection points on both the Nasdaq and the S&P. Okay, I don't talk about gold a lot. I'm not a fan of the asset class or owning it. There's no earnings, there's no dividend. It's a store of value. I get it. I don't want to argue about it. But what I'm saying to you is that I do chart it, because when you start to see these moves higher, these big gap moves like we're seeing today, you got to scratch your head a little bit and say, what's going on here? So the previous highs here around this we'll call it 2100, are certainly going to be resistance. Now, if that becomes resistance, that would be, form a triple top now. But if it breaks, it'll break the double top. So if it breaks that, I think you got another $100 on gold. I'm just calling that out right here. I've had this target for a long time, so I never took it off the chart. I'm not saying my targets are perfect, but sometimes it just takes longer to materialize. But that's what it looks like right now, and that could be a low target. Who knows? But until it happens, that's kind of where I see it heading. Okay, and last, kind of looking at sort of these macro themes here. You guys remember this chart? I had this built quite some time now, for over a year. White House makes the announcement that they're going to put a buy on oil between 67 and 72 to replenish the Strategic Petroleum Reserve, the SPR. I'm saying they missed it. I had that on there for a while, but now it's back. We're back in the zone. So look what it did. It got right to that level and bounced. I think it's going to probably migrate a little bit lower, I would think, depending upon the way this chart is forming. But this has been a tough one, and it's really been a push and pull on the stocks in the sector as well. They become volatile. They become obviously tied to the commodity, but at the same time, they're still printing money. They've been able to, at these levels, drill, produce, and sell oil with nice profits in their pockets. Just the lower it gets, that gets a little squirrely for those names. So just be careful if you're in the energy sector at all. Okay, I didn't want to leave today without talking about the US dollar here. Obviously, look at this turnaround. We had this big move higher. We stayed in this wacky range that I kind of called out as sort of consolidation. You would think that it was going to continue, but it did not. And that's what's happening when the Fed, when your people are reading into the market, looking forward and saying the Fed could cut rates and all that, could maybe potentially, all those words that you hear all over the place, things react to it. So nothing happens in a vacuum. And that's what I'm seeing on the dollar here. It's obviously rolling over. Anything lower here obviously is going to propel not only international stocks, but even our multinational names here as well, which is helping to support higher levels in all of the markets that we're seeing, especially small caps. Okay, I'm working backwards here. I said I was going to look at the sectors. Here's the, our sort of what we call our ETF comparison, and it really kind of ranks the sectors in order. Now, how about this? I haven't seen this in a long time. I've got the S&P sort of ranked higher. Now, this is our internal ranking, but it is very bullish, but so is communications and info tech here as well. Technology sector, XLK, both doing extremely well. But look at energy. As I said to you, this has been up and down the ladder a few times this year, and here it is at the bottom, but climbing higher. See the little green arrow? Over the past week, it did a little bit better, and it's up from a ranking of, a low ranking up to a higher ranking. But my point is that it's moving in the right direction. Now, staples moving in the opposite. It's really the only bearish sector. Now, when I say that on our ETF rating, it's very technical. It's actually heavily technical. And when you're looking here, it does combine the ratings of the stocks inside of the ETF, but also it really looks at the trend of the ETF vehicle itself versus every other ETF in the market. That's every other ETF, fixed income included. Doesn't sound fair, but the point of it is that when you're looking at trends of a specific type of vehicle like an ETF, we're just looking for the best ones, right? And so the sectors certainly come into play, and obviously all of the other things fall into place. But when I'm looking here, I've got communications, XLK, and oddly enough, this is a surprise to me, XLF. So I'm actually going to look here. If I double click this, what's going to happen is it'll build the ETF and it'll load all of the symbols here. But how about this? This thing recently turned bullish. And when? Well, when people started talking about rate cuts. Now, for the life of me, I understand there's a spread on lending. I'm pretty well versed in that, worked for several banks. And yet at the same time, I'm not sure how lower rates should help propel banks. Now, obviously, that could create loan growth and things of that nature. But what I'm saying to you is the spread may not change. And that's what I think a lot of people are seeing here. So in other words, they can still lend out, make the same money. If rates are lower, demand could increase. And that's why you're seeing a lot of these, even the regional banks. KRE had a big move recently and up almost 3% today. And now KBE, which is just the banking sector ETF, up over 2.5%. Now, that one looks a little bit stronger to me, but they're both looking great, and you can't deny it. They're both looking like, where they're heading in the upside direction. So you can see where we are here now. Let's look at subsectors. This has been on top for quite some time. The insurance sector, KIE. A lot of names in here are bullish, and I think this looks really good. I might be honest with you. But here's another one, XLB, which is pretty amazing. What a turnaround this has had. Again, when rates were considering, should I say, people are talking about rates moving lower from a Fed rate cut, but that could be because of bad news, folks. Again, if unemployment spikes higher, that means more unemployed. Things could get a little squirrely there. But look at the turnaround. This is pretty amazing. Almost, really identifying a short squeeze here. There's no doubt about this. This kind of reversed and took it all the way back to where? So basically levels of July, where we saw the markets at previous highs, and that's exactly where the S&P is today. Now, there are some names in here that just don't look great. Now, you see a lot of these have little signals on them, like Lennar's got an oversold buy, MDC, which is a household durable company, also an oversold buy, but not quite there on the relative strength change. But two names like TPX. Let's look at this one. This is a household durable as well. But this is the one I'm saying I'm having trouble with. I got negative money flow, it's below the trend, and I got a negative relative strength, and I'm overbought. The problem here is that if you're underperforming in this kind of market, you're not getting that push. This is an alarm going off here. Even though it's up about 3.5% today, it's getting pushed and pulled with the market. But look at that gap lower, has not been filled. I would think that gets filled first, and it should hopefully hold. If it doesn't hold here, it's going lower. That's just the way I see it. And the other one that came in was CHTR, Charter Communications, a media company. Now, when you click here on this, I can see that, this has not been a great chart, but I start to see that relative strength breakdown, a lot of negative money flow, and kind of living around the long-term trend. It doesn't look great, but let's look at the media sector in general, the way we view it. We've got a lot of really, what should I say? It's a mixed bag, but there's a lot of stocks in here that are neutral. Big names like Comcast, Fox, News Corp. All of these are sort of neutral. News Corp's got a better looking chart, but when you start to look at like Fox, it's a downward trend, right? Comcast is kind of breaking that trend as well. So if you've got any exposure here, not sure why this is happening. Again, that's not really important to me, not yet anyway, but I am seeing that and I'm just calling it out. If you have any exposure here, just be careful. All right, folks, thanks again. That's the halftime show. I'm Pete Carmesino here at Chaikin Analytics, your chief market strategist. I really appreciate you tuning in. We'll be back next week. I hope everybody had a great holiday. And here we are back again. The markets are rip-roaring and ready to roll. And we've got the month turning into a new month. December 1st is Friday. And all the new news is going to be coming out next week. So, like I say, fasten your seatbelts. I think it's going to be volatile, but hopefully more volatility to the upside than the downside. Take care. See you next week.